European banks are currently at their best since 2008, but the road ahead is anything but smooth. This article explores whether the sector is hitting its peak or just beginning to soar. Let's break down the key factors driving this surge and the hidden risks that could shift the balance. A rally built on strong earnings. European banks have surged over 40% this year, outperforming broader markets by more than double. This momentum stems from strong earnings fueled by higher interest rates in recent years and improved growth outlooks. However, analysts warn that this may not last. As rates drop and tariffs increase costs, banks may face lower profits and higher loan losses. For instance, French political instability has already shaken investor confidence, with Société Générale's shares dropping sharply amid fears of government collapse. The rate cut dilemma. Even if earnings slow, banks may still benefit from a stable interest rate environment. The European Central Bank has paused rate cuts, and negative rates are a distant memory. But this isn't a guaranteed safety net. A recent study found European banks are far more sensitive to rate changes than their U.S. counterparts, with 60% of their income tied to interest margins. While rates are expected to hover around 2%, the looming EU-US tariff deal could reignite economic uncertainty, complicating the picture. Winners and losers in the sector. Not all banks are thriving equally. German and Spanish lenders are benefiting from strong economic growth and M&A opportunities, while Swiss banks like UBS struggle with US tariffs, zero interest rates, and new capital rules. In France, renewed political turmoil has sent shockwaves through the banking sector, with Société Générale's shares hitting their worst daily drop since April. Meanwhile, UK banks face pressure from proposed taxes on bank reserves, adding to the challenge. Less risk, more reward. Investors are increasingly viewing banks as low-risk assets. Credit default swap prices, which measure default risk, have fallen, reflecting improved confidence. Even AT1 bonds, high-yield debt that can be converted into equity, have recovered after the Credit Suisse crisis. Experts like Ian Birrell note that these bonds offer high returns without the stigma of speculative grade status. Is now the time to buy? Opinions split on this. Some analysts, like Christian Solé, remain cautious, arguing that while the sector is strong, valuations are inflated. Others, such as Morgan Stanley, urge investors to buy the dip, seeing current weakness as an opportunity. But with recession risks still unpriced and political storms brewing, the next few months will test whether this is the peak or just the beginning. What do you think? Are European banks on the cusp of a historic high? Or is this a temporary rebound? Share your thoughts in the comments below, because the real story isn't just in the numbers, but in what they mean for the future of finance.